Hello and welcome back to the RockFX Hub. I'm Peter, or as most of you know me, Peter the Rock. Today, we're going to peel back the curtain and understand how the Forex market actually works. You see, trade confidently, you need to understand the structure behind what you're trading, who's involved when it operates, and how money truly flows around the world. This lesson is based on Chapter 3 of Forex for Beginners by Anna Coulling. Anna calls the Forex market a living system. Decentralized, global, and constantly evolving. And that's exactly what we're going to unpack today. By the end of this session, you'll understand what drives Forex when a trade and why timing is everything. What makes Forex unique? Unlike the stock market or commodities exchanges, Forex has no central exchange. There's no building where all trades happen, no single clock that opens or closes a market. Forex is decentralized. It runs through a network of banks, institutions, and brokers connected digitally. Imagine a living web. Millions of traders worldwide buying and selling currencies simultaneously. That web never sleeps from Monday to Friday. In her book, Anna explains that this decentralized design gives Forex three major strengths. 1. Accessibility. Anyone with internet access can participate. 2. Liquidity. Because of massive trading volume, over $6 trillion daily. 3. Flexibility. Traders can choose sessions that match their lifestyle. When I first started trading, I was amazed to learn that the same euro to US dollar pair might behave completely differently depending on the time of day or which financial center is open. That's because the Forex market operates through trading sessions, London, New York, and Sydney/Tokyo. And each session has its own rhythm. The 24-hour market. The Forex market runs 24 hours a day, 5 days a week. It opens on Monday morning in Sydney and closes on Friday evening in New York. Here's how the daily cycle flows. 1. Sydney session. The market opens here first, around 10 p.m. Greenwich Mean Time. This is often the calmest period, perfect for planning rather than heavy trading. Pairs like Australian dollar to US dollar and NZD/USD are most active. 2. Tokyo Asian session. An hour after Sydney, Tokyo joins in. This session adds more liquidity, especially for JPY-based pairs like US dollar to Japanese yen or pound sterling to Japanese yen. But volatility is still moderate. 3. London session. Now things get exciting. Around 8 a.m. Greenwich Mean Time, London opens. The largest Forex center in the world. Most institutional volume comes from London banks and hedge funds. You'll notice pairs like euro to US dollar, pound sterling to US dollar, and US dollar to Swiss franc waking up fast. 4. New York session. Finally, New York opens around 1 p.m. Greenwich Mean Time, overlapping London for a few powerful hours. This overlap is where the real action happens. Massive liquidity, news releases, and breakout moves. When New York winds down, Sydney slowly takes over, and the cycle begins again. Anna Coulling describes it beautifully. The Forex market is like an ocean wave. Constant, connected, and global. Learning when those waves rise and fall is the first secret of trading success. The participants who moves the market. To really grasp how Forex works, you must know who makes it move. Pause 1. Let's break down the main participants. 1. Central banks. These are the big players. The Federal Reserve in the U.S., the Bank of England, the European Central Bank, and the Reserve Bank of Australia. They don't trade for profit. They trade to stabilize their currencies, control inflation, and support their economies. For example, when the Fed raises interest rates, the dollar usually strengthens because investors want higher returns on U.S. assets. 2. Commercial banks and hedge funds. These are the whales. They handle currency conversion for clients, importers, exporters, and global corporations. But they also speculate heavily, placing large trades that shape short-term trends. 3. Corporations. Companies like Apple or Toyota trade Forex to manage global payments and hedge currency risk. If Apple sells iPhones in Japan, it'll convert yen profits back into U.S. dollars, creating daily currency flows that move markets. 4. Retail traders. People like you and me, we make up a small slice of the pie, roughly 5% of total volume. But thanks to online brokers and leverage, retail traders can access the same markets as the big players. Anna reminds us, though, that retail traders often react to moves rather than creating them. So learning to recognize what the big players are doing and then aligning with them gives you an edge. Liquidity, volume, and volatility. One of the reasons traders love Forex is because it's liquid, meaning you can enter or exit trades quickly. Liquidity is highest when major sessions overlap, especially London and New York. Anna Coulling points out that high liquidity reduces slippage and tightens spreads, meaning your trades execute closer to your intended price. But there's another side to it, volatility. Liquidity brings opportunity, but volatility brings risk. During quiet hours, say late in the New York session, price tend to move smoothly, but during heavy hours, such as when the U.S. releases non-farm payroll data or when the Bank of England announces interest rates, the same pair can spike 100 pips in seconds. The key is to understand that liquidity and volatility dance together. When one rises, the other follows. And as a trader, your job is to find balance between them. Brokers, servers, and price feeds. So, how do you actually connect to this giant network? Through your broker. Anna explains that brokers act as your bridge to the interbank market, connecting you to liquidity providers and price feeds. There are two main types. ECN brokers. They connect directly to the market. Market makers. They create an internal market for clients and manage orders themselves. Neither is automatically good or bad. What matters is transparency, execution speed, and spreads. Behind every chart you see, euro to US dollar, pound sterling to US dollar to Japanese yen. There's a stream of constantly updating quotes coming from multiple banks and institutions. Your platform, whether it's MT4, MT5, or TradingView, simply visualizes that flow for you. So when you hit buy or sell, your order joins a massive digital network. Like a droplet in the global financial ocean. The role of news and fundamentals. The Forex market breathes with economic data. Every central bank announcement, employment report, or inflation figure can move prices instantly. Anna emphasizes that understanding why currencies move is more important than chasing the move itself. For instance, when the U.S. releases strong jobs data, investors expect the Federal Reserve to tighten monetary policy, making the dollar stronger. Similarly, if inflation in the U.K. drops unexpectedly, traders might expect rate cuts, weakening the pound. That's why professional traders always check the economic calendar before opening positions. They don't guess. They prepare. As Anna says, the market doesn't move randomly. It moves because someone somewhere made a decision when to trade and when not to. Knowing when not to trade is just as important as knowing when to enter. Anna teaches that the best trading windows are during high-volume overlaps, when multiple markets are active. For example, the London-New York overlap between 1 p.m. and 5 p.m. Greenwich Mean Time is prime time for majors like Euro to US dollar and Pound Sterling to US dollar. For Australian traders, early Sydney-Tokyo hours suit Australian dollar to US dollar and US dollar to Japanese yen pairs. Avoid trading right before major news if you're not experienced. Spreads widen and slippage can hit your stop loss instantly. Also, stay cautious on Friday afternoons. Institutional players close positions for the weekend, often causing sudden reversals. Remember, timing is strategy. Trade when the ocean is alive, not when it's flat. Recap and closing. So let's recap. 1. The Forex market is decentralized and global, running 24 hours a day. 2. It's divided into sessions, Sydney, Tokyo, London, and New York, each with its own character. 3. Liquidity peaks when sessions overlap. 4. The main participants are banks, corporations, and traders like us. 5. And success comes from knowing when to trade, why markets move, and who is really behind those moves. If this lesson brought clarity, make sure to like, subscribe, and turn on notifications. Drop a comment below telling me which session you usually trade and why. In our next video, we'll explore brokers, platforms, and trading tools. How to actually place trades, manage risk, and navigate MT4 or MT5 like a pro. And if you haven't yet, grab Anna Couling's Forex for Beginners. It's the perfect companion for this journey. I'm Peter the Rock, and this is the Rock FX Hub, where knowledge meets profit. See you in the next lesson.